So we all got these yellow balloons.
We talked a little bit about time value. There's your option expiring a month from now, 2 months, 3 months, and 4 months. That time value comes out quicker and quicker in the option. And that right there is time decay.
Hey, camera.
Oh. Hey, I'm Desiree.
I'm Denver.
Welcome to Options Trading Essentials, a video series dedicated to teaching you the ins and outs of options trading. In this episode, we continue our discussion around options pricing. Specifically, we're going to break down intrinsic and extrinsic values.
We love fancy words in options trading, but really intrinsic and extrinsic are just ways to think about which part of an options premium is related to its real value compared to its time value.
And the good news is, with some simple addition and subtraction, you can figure out which part of the options premium is intrinsic or extrinsic value.
That's right. We'll walk you through the process, and later on, Kendall and Obi will help us calculate the values using real-life examples. But first, Desiree, tell us more about intrinsic and extrinsic value.
Let's do it. The total value of an option can always be broken down into two parts: intrinsic and extrinsic value. Intrinsic value is how far an option is in the money. To calculate this, compare the price of the stock to the strike price, and some simple addition and subtraction will do the job. It's called intrinsic value because if you were to exercise the option, this is how much value would be built into the resulting stock position. Meanwhile, extrinsic value is everything within the price of the option that is not intrinsic value. This is often referred to as time value because, holding all else equal, it will decrease with time as the options get closer to expiration. This is the portion of the option that is forfeited or given away if the option is exercised. To calculate extrinsic value, take the option's premium and subtract the intrinsic value. This gives you the extrinsic value. Just remember, these values are not static. They change constantly as the underlying stock moves up and down. Obi, can you give us some examples?
All right, let's take a look at an example of intrinsic and extrinsic value. One thing to always remember, every option premium at its highest level can be broken down into two parts. Its intrinsic value and its extrinsic value. Our intrinsic value is the amount that the option is in the money. Now, for call options, this is when the stock price is greater than the strike price of the option. For puts, this is when the stock price is less than the strike price. When that happens, that amount, that difference between the stock and strike price is the in the money amount or intrinsic value of the option. Now, what about extrinsic value? Well, you can think of extrinsic value simply as the rest of the premium, right? Whatever isn't intrinsic is extrinsic value of the option. And we can calculate this by simply taking the option premium and subtracting that intrinsic amount, and that will get us our extrinsic value. So if we have an option that is out of the money, first thing to remember is there's no intrinsic value. So in this case, if the stock hasn't gone above the strike price of a call option, or in the case of a put option, the stock hasn't gone below the strike price, there's no intrinsic. The option is not in the money. And so whatever premium you see for an out of the money option, that is all extrinsic value. Very simple, nothing to calculate there. Remember, an out of the money option has no intrinsic, so the whole premium is extrinsic. All right, let's take a look at a couple examples on how we can calculate intrinsic and extrinsic value, looking at some hypothetical examples. So here I have XYZ stock, and we're just gonna say it's trading for $100 per share. Now, we have calls on the left and puts on the right. And let's imagine that we had both a 110 strike and a $95 strike, which would be below the current trading price. Now, let's take a look at the 110 call option here in the upper left-hand corner. Let's just imagine this option has a premium of $1.50. Now, first question we have to ask ourselves is this option in or out of the money? Well, at this point, the stock price is still below the strike price. So at this point, this 110 call option would be out of the money. And so let's just do some quick intrinsic and extrinsic calculations. Remember, intrinsic plus extrinsic equals the premium. Now we know the premium is 150. We know there's zero intrinsic value because this option is not in the money. So we can then assume that this whole option is worth extrinsic value only, meaning it's out of the money. Let's look at the 95 call. Now this option would be in the money, right? Because the stock price is above our strike price of the 95 strike. Now let's just imagine this option is trading for $8.25. We know that the difference between the strike price of 95 and the stock price of 100, that's about $5 right there. So that would be our intrinsic amount of the option. So that's our intrinsic value. Now the option's trading for $8.25. So if we subtract our $5 of intrinsic value, we now know that $3.25 of that option is extrinsic value. What's important here is if we were to exercise this $95 call option to try to capture this $5 in value on our stock position, we would be forfeiting this $3.25 of options premium. And remember, every option is worth 100 shares of stock, so that would be $325 that we would be forfeiting by exercising our option. All right, let's jump to the put side of the option chain. We're gonna go back to this 110 put. Remember, the 110 call was out of the money, so therefore the 110 put will be in the money. And that option right now is trading for $11.50 hypothetically. So we can do the same calculation. We're gonna take the strike price of the option, which is 110, and we're gonna subtract it from the current share price of $100. That's an easy calculation, that's $10. And so we know that of this $11.50 of premium, $10 of it is our intrinsic value. Now, the option's trading for $11.50, so we just subtract that $10, and we know that this option has $1.50 of extrinsic value. Same concept. If we were to exercise this option and sell shares at 110, there would be value built into that option because the current share price is $10 lower. But if we were to exercise this put option, we would be forfeiting this $1.50 of premium, which in real dollars is $150. Now let's go down to the 95 put. This put would be out of the money because the strike price is below the current share price. Therefore, if the option's trading, for example, for $3.25, we know that there's no intrinsic value because it's an out of the money option. So we can assume that the whole premium of $3.25 is our extrinsic value.
Extrinsic value, also known as time value, is always going down as an option approaches expiration, all other factors remaining constant. This is called time decay. It starts slowly, but as time goes by, the rate of decay begins to increase exponentially. Think of time decay like an ice cube. It melts slowly at first, but as the ice cube gets smaller and smaller, it melts faster and faster. An option loses its extrinsic value in a similar fashion. Buyers of options are always losing time value. It works against them because they want the value of the option to rise. Sellers of options have time decay working for them because they want the value of the option to fall. So remember, when you trade options, time passing can be your best friend or worst enemy, depending on which side of the trade you're on.
So you've just heard a lot about intrinsic and extrinsic value. Let's see some examples. Will you take us to the options chain, Denver?
Can do. All right, I'm in the technology mood. How about AMD? Great, so we are on our homepage. Once again, let's go to search. We're gonna look up AMD. there we are. I'm gonna select it. We're gonna select trade options. We hit the options chain. I'm thinking we do October 15th. All right, so we're gonna do 4 examples here. Let's start with in the money calls. Kendall, can you walk me through what I'm looking at right now?
So let's take a look at an in the money call option first and break down this premium that you're seeing. So if you look below the share price again, all of those contracts are gonna be in the money right now. So let's pull up a $100 call just for the sake of simplicity here. So let's really break that down. We have the $100 call. 100 is our strike price. Share price is 105.60. The in the money amount for this $100 call is about the $5.60 right now. But you notice the premium is at $10.33. So there's obviously a larger gap there. It's trading at more than the intrinsic value. So what is all that extra premium? That's going to be the extrinsic value, which is also that time value associated with this contract in the market.
Yeah, and very important point here. If you were to buy this option for $10.35 right now and exercise your rights under the contract, that is not necessarily a great thing to do because you would be forfeiting or giving up that extra $4.50 a premium of extrinsic value. And this is something a lot of new options traders don't understand right away. They think, oh, I'll just buy this option for $10, exercise my rights to buy the stock at 100, and I could sell it for a $5.50 profit. But you paid $10.33 for the option because we're looking at options that expire in about 60 days, and that's that extrinsic or time value. And we're going to talk a little bit about this later in this segment here, but that time value is going to differ across different expirations.
Yeah.
Now, following up on that, Obi, since you're on it, let's examine out of the money calls.
Well, the good news is there's not much math to do here because with out of the money options, there's no intrinsic value, right? Because if we bought, say, the 120 call, which right now is trading for right around $3, there's no intrinsic value. The option is not in the money. So as Kendall just said, in the money amount equals intrinsic amount. But with this option is not in the money. So all of the premium you see in any out of the money option, whether it's the 110 call, the 115, all the way up the option chain, all of that is extrinsic value or time value. So when you buy an out of the money option, you're buying an option that has no intrinsic value. You're buying all time premium. That's a huge distinction. But in terms of doing the math, Denver, you look at the price of the option, that's the extrinsic amount because you know intrinsic is 0.
So when you buy an out of the money call, then you have faith that it's gonna maybe be in the money in time?
Faith, it's an interesting word. I learned back in the day, hope is not a trading strategy.
Okay.
But yes, in many ways, when you buy an out of the money option, you have an opinion that the stock will make a move in that direction. So if we, for example, bought the 120 call on AMD trading for $3, our expectation is that we think AMD would be above that strike price by October expiration. But one little detail I want to throw in, and this is a little sneak preview of future videos, you have to take into account what you pay for the option. So theoretically, for us to break even or kind of make sure we neither profit or lose on this trade, you would have to add the premium you paid to the strike price. So the 120 call trading for $3, we would need AMD to be at 123 or higher by October 15th for us to have a profit at expiration.
I think it's a really great point, Obi. I'm looking at it right now. I see the break even, that the app shows it, right?
Exactly. When you look at any option on the option chain, we are doing the math for you, at least in terms of break even. So you just simply take that strike price, 120, add in that $2.98 premium, and there you have the 122.98 break even point. So the app is telling you, Desiree, or anyone watching, if you were to buy any of these options, taking into account the premium you're paying, which is both intrinsic value for an in-the-money option and all extrinsic value for an out-of-the-money option, what your break-even would be at expiration if you bought that option.
Wow. Okay. All right. So let's switch gears a little bit and let's flip it a little bit. Let's go to the put side. Kendall, I want to go back to you. Give me some details. What am I looking at?
Yeah, definitely. So similar, but now we've flipped it. So we're on the put side here in the app. So everything above the share price in the app is going to be in the money. So these are in the money put contracts. So let's take a look here at, let's say the 110 put, for example. Again, the share price of AMD in the market is at the 105.60 right now. So this 110 put is deemed in the money by about $4.50. So you're in the money by $4.50, but you can see this contract's premium right now is $9.90. So $4.50 roughly of that $9.90 is the intrinsic value of the premium, right? Because that is the in the money amount of that contract. So what is that other $5 associated with that premium? Well, that's the time value or the extrinsic value of that premium.
Got it. And I notice again, as you go up, they get more expensive, these premiums.
Because you're getting deeper and deeper into the money.
And in Denver, the out of the money options on the put side are just the same. Since there's no intrinsic value, whatever premium you see on the out of the money put options, which on the Robinhood app is the options below the stock price on the put side of the option chain, you know, the 100 put, 465, the 95 put, 293. That's all extrinsic value.
Yeah, I love it. So we all got these yellow balloons. Obi, can you tell us why we have these?
All right, so what we're gonna do, we talked a little bit about time value. So real quick, if we go back to our option chain, we'll look at the AMD calls again. Let's look at the 120 call. Stock's trading at 105.50 roughly. And the 120 call in October has a premium of $2.93. Denver, what's the premium on that same 120 call in November?
We are looking at $5.03.
$5.03, so almost twice as much. Desiree, let's go out to the December options.
$6.10.
Okay, so even a little more. And then Kendall, let's go to the Jan 21.
$7.40.
Okay, so we see every option out in time gets more expensive, and we're only looking at options with nothing but extrinsic value. So what we're gonna do, we're gonna blow up our balloons. I'm gonna ask Desiree, I just want you to blow up your balloon just a little bit.
Okay.
Denver, a little bit more than hers.
All right.
Kendall, more than Denver, and I'm gonna blow up the largest balloon here.
A little more.
Oh, yeah.
So as we talked about, we kind of line these up in a row, right? There's your option expiring a month from now. There's your option expiring 2 months, 3 months, and 4 months. All things being held equal, meaning stock price doesn't move, we know the strike price doesn't change, and we know there's this thing called implied volatility that we've sort of been alluding to, we're gonna talk about very soon. If we pause all three of those factors, we know there's this fourth factor called time, or days to expiration. So let's slowly show time decay using these balloons. So kind of let everyone at the same time let air out of their balloons.
Okay. Mine was a weekly option. Monthly.
And there you see, as we get closer and closer to expiration, that time value comes out quicker and quicker in the option. And that right there is time decay. So if we bought those out of the money options and nothing changed, the premiums that you pay for those options would eventually go to zero because they wouldn't be in the money by expiration. Now, the one last thing I want to point out is what if I told you that this balloon could increase or decrease and it had nothing to do with time or price? But it has to do with what the market thinks is going to happen in the future or the supply and demand of options, and that's implied volatility. On the next Options Trading Essentials.
Implied volatility is one of the most important factors to understand when trading options.
The options market is always pricing in their best guess at what might happen in the future.
What does this have to do with options? A lot, actually.
Implied volatility has a major impact on the price of the option.
Thanks for watching the video. If you enjoyed this episode, smash that like button, leave a comment, and don't forget to subscribe to the channel to get alerted when new episodes become available. Remember, options involve risks and are not suitable for all investors. Before trading, check out the link below in the description.